And this is Tom Hulick. I am the CEO of Strategy Asset Managers. We are here today on the 19th of July for the mid-year market update and what you can expect for the second half of the year. Joe Traba, our portfolio manager, Alex Hagstrom, and myself, we will cover also why the second half of the year could be better. I'm going to turn it over to Joe right now, and we'll get started. Joe?
Thank you, Tom. So like Tom said, before we go into why we think the second half of the year will be better than the first half, I like to recap and kind of go over what happened in the first half of the year. Now, most of you know, we did enter a bear market, and we'll go into that in a little bit, but the market reset growth expectations, and this is due to higher inflation, rising interest rates, and obviously the global supply disruptions. What happened? Well, the market entered a bear market, and that just means the S&P was down more than 20%. NASDAQ was down more than 30%. You even had international markets down over 20%, and bonds were down over 10%. This doesn't include the crypto and momentum types of stocks, which are down considerably more. But I want to let you know that what this market so far has experienced is part of the market cycle. And we did talk about resetting of expectations. And this is as it relates to global central banks not being as accommodative when they were during the government lockdowns. Now, the headline news is out there. Oh, this is the worst start of the year since 1970. But we also want to let you know that sentiment is correct. It is at all-time lows. And I'm going to share with you why this is good for future returns. And more importantly, we've said this before, sentiment controls short-term price movements, but long-term drivers of the stock market remain corporate earnings. So why is the market down? Well, the risk of surging inflation and the unwinding of the stimulus policies, that is discontinuing to create uncertainty. Now, we also got the CPI numbers that did rise again in May. And again, this is the fastest growth since 1981. It just means all of us know this, inflation is high. The cost of goods when you go shopping is high. When you go fill up your tank, for those of you that have gasoline, that's up. So the worry is inflation is out of control and that the central banks are going to have to do significant rate increases to slow economic growth. This is kind of putting brakes on the economy. And we just started to see the Federal Reserve, again, this year, raise interest rates. But what's interesting, unemployment rates have not, gone up. That means we have a tight labor market. So we are seeing some positives that are coming from this market. But again, the market is a discounting mechanism. And what it's doing is discounting the fear and panic of people getting out of the market because of the unexpected. Now, we talked about briefly, what is a bear market? And that just means when a market is down by 20%. The next question we get, just because we have a bear market, does that mean a recession is imminent? And we'll go into details why that's not necessarily true. So you can have a bear market, and actually it's happened 13 times since World War II, and 9 of those did not coincide with a recession. So I like to look at history, and sometimes you can find some similarities. So again, the good news is that when you do have a bear market, it is much shorter when it's not in a recession. So for the question now is, are we in a major recession or a mild slowdown? So for right now, we are seeing it's a slowdown. We do not think this is 2008. In 2008 was a lack of confidence in the financial system, nor was it 2020 when the government shut down the economy. Again, we continue to see the US economy is healthy and it's not deteriorating. Now, inflation data, recent data, I know the CPI numbers are high, but we are starting to see some lower price points coming online, and we'll go into detail for that. So what we really want to focus in on and want you to come out of this meeting is why the second half of this year could be better. And one first note I like to go again is history. And every time we look at the S&P, when it suffered a big first half loss, which we saw this year, what does history show us what happens during the second half of the year? So when the S&P has fallen at least 15% in the first 6 months of the year, it did this in 1932, 39, 40, 62, and 1970. It has risen an average of 24% in the second half. Okay, so maybe it's not one of those years, but again, that's what history is showing us. Now, we also look at, again, some of the cyclicals and seasonality patterns. And again, the market, what we've said before, it's already repriced future rate hikes and has done a lot of work that the Fed was expected to do. We'll go into why the commodity prices are coming down. And that has been a really strong correction over the last several weeks. In fact, you saw gasoline prices drop for almost 25 days in a row. So we do think you're going to see inflation cool as the summer months go on. And that's going to help the Fed not be as aggressive in raising interest rates. Now, these two components will help companies, but also households plan for their future. So with that, I want to go into why we're seeing some signs of moderating inflation. And again, commodities, that's one thing that we look at. That has fallen significantly in the last couple of months. And we actually got some housing data today that's showing some building permits, which are a forward indicator, cooling off. I'm going to have Alex jump in to go over some more of the details.
Yeah, so we're in the midst right now of very significant commodity price deflation. This happened extremely quickly in some cases, but at this point, basically every commodity is down 20 to 50%. This is very encouraging since commodity prices right now are the largest component of headline inflation. Inflation with energy and food stripped out, which is called core inflation, has actually decreased for 3 months in a row. We've seen basically every commodity except for oil sell off, but oil had remained strong due to the war in Ukraine. That's now reversed. Oil's down nearly 20% in the past month, and gas prices, which are already down 10% on a national basis, should follow if oil remains where it is. Commodity prices basically always revert to the mean over long time horizons, one way or another. It tends to just be a matter of time. It can be hard to determine exactly when, but it looks to me like this natural mean version's happening right now. Gasoline demand in particular has fallen a lot in the past month. It's close to where it was in July of 2020 when we were in the heart of the lockdown. And outside of COVID, this is actually the lowest demand we've ever seen in modern history. That's actually positive in the long run. It's a natural part of the economy healing itself. It's supply and demand adjusting and trying to find a price that makes sense. That natural healing process is also happening with the US budget. As all of you know, the policy response to COVID resulted in a massively spiking budget deficit. The deficit reached levels we'd only ever seen around the Second World War. However, that's completely reversed now. The budget deficit's basically right where it was in February of 2020. I think given the inflationary consequences of the policies enacted during COVID, that policymakers are going to be reticent to ever run a massive deficit like that ever again. Now, don't expect the US government to run a surplus or cut spending or anything like that. That's just not something that happens in America. But the really, really massive deficits are gone for the time being. The deficits today is roughly where it was in the early 1980s, which, as we know, was a time of great prosperity for America. Now, don't get me wrong, the debt's definitely unsustainable in the long term, but at the moment, America should be fine on that front and is certainly in much better shape than the rest of the world, especially China and Europe. The strength of our currency and the capital flows from foreign investors are really expressing that right now.
Yeah, and again, that's a key point is we do think the final total of rate hikes will be still historically low. And that's what, when we look at interest rates, at a yield curve, that's what it's showing. So my next point is, what have stocks already priced in? And this is a great segue into what's happening right now. It's quarterly earnings reports. So every quarter, we hear from companies reporting their earnings, and that's happening really in just this week and next week. So we will get a better picture over the next few weeks how companies are coping with these headwinds. Now, this backdrop, it actually paints a better than feared environment. So this is where you're hearing companies coming out and actually lowering their guidance. And again, they are still growing. They're just not growing as fast as they did last year, in which we had the post-pandemic recovery. But again, the fact is they're still growing. And again, that's when we get supply chains back to pre-shutdown levels. That's also going to help corporations manage, excuse me, manage their navigation much better. And that's just what we saw with the supply disruptions and consumer spending changes. So what a positive sign is when we start seeing companies lower guidance, and some did this morning, and yet the markets rally. That means they're better than feared expectations. And that's something that the market can rally off of, or at least find a bottom. And we'll see in the preceding quarter how things go. So guidance has been lowered, but we're still seeing growth. And again, that's what happens when expectations have been lowered so much, it actually can now beat those estimates. Another thing that we look at, or indicator, is bearish sentiment. Now, negative sentiment, that continues to remain at extremely high levels. And it's actually interesting, you have a couple of indicators that are low levels since they've started tracking this. It's another Bank of America, the American Association of Individual Investors. All of these are just showing that consumer sentiment and how people are positioned is extremely defensive. In fact, cash levels are at the highest level since 9/11. So you have people very defensive oriented and set up going into the second half. That brings us to what happens if the markets normalize, and what happens if we start hearing positive news. That's a shift in sentiment. As the sentiment improves, that short term and earnings, again, growing, will still be positive for the market. So when we've seen this type of repricing in the first half of the year, again, we are painting a picture where inflation pressures will start to ease. And again, gasoline demand is one of the key components that we all feel at the pump. And that's going to start slowing, especially after the summer months. And again, demand for houses, which we saw today, that's also confirming a slowdown. For me, it's what happens when we get China fully reopened. That's going to lock a lot of the supply chain disruptions. So yes, COVID-19 is still in the news, and that is also adding some fear. With this backdrop, what does that mean for you and for your portfolio? What areas of the market may be positioned to do well? And again, the US, when we look at the globe, the US is still in an expansion phase. This is by measuring manufacturing levels. So we are in a much better shape than in Europe and also in China. What do we like to own? Now, we invest in companies with strong cash flow. We like companies with pricing power. What does that mean? That means companies that can raise their prices to combat inflation. Some of the sectors, healthcare, energy, and some technology. Now, we know the markets had a very rough first half, and our outperformance in our strategies, that's our worldwide dividend plus, our worldwide equity, and our worldwide balanced, all are significantly outperforming the S&P, and even our growth is outperforming the growth benchmark. A question that we get asked, well, if I'm sitting in cash, what can I do? Now, we do think there are some tactical investments that we've done, but it's also because interest rates have risen so much, you can actually buy really short-term instruments and get a 2 to 3% yield. So there are places not just to hide, but to take advantage of as we go forward. So with us, the bottom line, we do think there's been heavy selling. There's been a tremendous lack of conviction in the markets, and that's where we get a bear market cycle that's developed. But you should know, you could see the markets trade sideways. It's going to take some time to base and rebuild. But historically, when we see this much negative sentiment, what do the markets do in 6 to 12 months? They are higher. And I hope we pointed that out so you could see where our optimism comes from. Now, we do see inflation slowing down, and this is going to help the Fed not over tighten, meaning not raise rates as fast or as high as some people have expected. That'll allow companies and us to better plan for our future. And again, we will see some negative news with earnings coming out. Profit margins will be lower. That's going to hurt some valuations. But our view is that the Fed, because of what the market's done already, you'll start seeing these concerns dissipate. And that's going to give us a better outlook, not just for the end of the year, but also as we position for 2023. So we do think there's a lot of optimism that's out there. It's not what the headlines are telling you. Some of the key points for us, again, why we are optimistic for the second half of the year, that has to do with inflation cooling off, interest rates still being at historical low levels, and earnings continue to grow. Now, the backdrop for that is sentiment is extremely negative, which is actually a positive catalyst because now you get a relief rally. Things aren't as bad as feared. And that's something that you can grow off of. We do get a few questions about Ukraine. And I'm going to ask you, what happens if we get a ceasefire in Ukraine? Lower prices means lower demand for potentially Russia, and maybe we see Putin come back to the table. So that could be a positive that we'll see, and the market's just not positioned for that. In return, we could also see, again, with earnings coming in still positive, that does lead the markets to higher, and same thing with 2023. Now, there are risks out there, and a policy overstep, meaning they raise rates too fast, too soon, and inflation continues to remain out of control. But our optimism is based on the US consumer, and we continue to see strong retail numbers. For any of you that's shopping, you're going to see a number of discounts out there because of the large inventories from the supply disruptions. So that's good for the consumer. So we do see positives out there, and we do want you to remain optimistic for what we're seeing for the second half of the year. Tom, did you want to open it up to some questions?
I would, Joe. I think I'm going to ask a couple of questions just to start things off. There are two ways that you can ask a question. If you're capable of navigating the chat feature on the bottom of your toolbar, feel free to ask that way. We could actually open it up to open up the mute button for people to ask questions. But the first is that, in summary, we're focused on earnings, and there is quite a bit of optimism that you talked about, and that leads me to believe: are we too optimistic? Are we too optimistic, Joe?
That's a good question. So what we've seen is, again, revisions started at the beginning of the year, high single digits. They were revised slightly higher, and then we've just seen a steady of lower revisions. And yes, we're seeing profit margins get hit, but these companies are still reporting, positive earnings. So you can kind of think of people that were staying at home. Maybe they're not watching Netflix or binge watching on TV, but they're going outside. And we've talked about the experience. And that's just another type of the market that's doing well. Energy companies are having huge earnings, and you are seeing a pullback in the discretionary. So it's a reshuffling of the market. But overall, it still points toward higher earnings in the US.
Do you think that there are favorable returns right now in the fixed income area in comparison to, as you said, in the last 6 months, rates have become into a more favorable position for people who are looking for more income Would you talk again about that?
Yeah, and that's a key component because we've talked about before the end of last year, sitting in cash, you were lucky if you earned a couple pennies. Well, you now have cash instruments or short-term instruments where you can get a 2 to 3% yield. For me, that's pretty compelling. And you hold these bonds or short-term instruments to maturity, you're going to get a 2 to 3% yield. That is something good. But in the big picture, that's not going to keep up with inflation. And that's why I do like dividend paying stocks.
Sure.
That'll be higher than the inflation rate.
We discussed, just to summarize some of the negatives out there, the fears of inflation continuing out of control. You addressed that we're seeing signs of inflation kind of peaking and actually backing up. We also fear the how long the recession will last. Are we in a recession? Technically, we're not in a recession. We've talked about that in the last couple of calls, but whether we are or we aren't in a recession, a technical recession, which are 2 negative consecutive quarters of GDP growth, we are in a bear market. And the investors and the are feeling it. I'm optimistic about the second half of the year. You've talked about it. The timing of it is interesting, how we see the market up 2% today. And we can talk about the importance of being invested. Joe, would you talk about the importance of being invested?
Yeah, and it's twofold. One, typically when you're a bear market, if you this is when you get these days that are just outliers. Some of the strongest market performance is during a bear market. And you kind of look back this year, what did we see in March? The end of the March, we had one of the best weeks in stock market history. Then we saw this again in May. You had a 3-4 day period where you had this huge, increase in the markets. So that's kind of where we're at. It's important to, not bail when you're in a bear market because you get these gains. And then, like we said, looking at historical performance, when you've had this type of returns, meaning the S&P down more than 15%, what's happened in the second half of the year. So, I do think it's worth mentioning, if your time horizon is longer than 6 to 12 months, of course, it's a good time to get invested. The timing of it, if you're trying to market time, that's pretty darn hard. But we do think the markets are settling down here. And we'll see that with our technical analysis that we've performed. And again, that's looking at the bearish sentiment as well. So you could see, again, cash come back in as people get more confident. But a lot of people are looking for this magical signal, and you're not going to get it. And the markets will go up before you find something like that.
Right. Are we in a self-fulfilled recession prophecy? Are we going to think our way into a recession, Joe?
That's a good question. And again, I try to be very fundamental about this. We are seeing a slowing economy for sure. The leading indicators are not pointing yet to a recession. I think a lot of us already feel like we're in one. And as Tom mentioned, we potentially do already had 2 negative GDPs. But again, a slowing economy, I think that's the way I would phrase what we're going through right now.
I agree. Slowing economy is better than a recession. More accurate. Keep going.
Yeah, and that's what happens for me. It's always what happens next, and that's what you have to look at. Can't be backwards looking. You have to understand what happened, but how are you positioned going forward? So again, a lot of people have been very defensive oriented. And again, that's why cash levels are so high. And what typically happens, you do see some of the growthier components, and that's some of the tech. And that's really recently starting to perform better. So you could see the cyclical side, and again, led by tech, and maybe we like healthcare as well, have some good performance where it's significantly underperformed in the first half of the year. So that's something to pay attention to.
Yeah. Alex, I'm going to ask you just to give a couple of key closing comments, and then I'm going to have Joe summarize the call.
Yeah, absolutely. So I think the most important thing to understand about this inflation spike is that it was a consequence of government policy. This was not a natural inflation spike. This was first the COVID policies and now the war. So given time, the economy does naturally heal itself. Supply and demand adjust and inflation comes back down. And we will eventually see that happen. It's been delayed because of the war, right? Just as COVID was healing, we had the war on top of it. So it's kind of hidden that this natural process is occurring, but it is occurring, it will occur, and inflation will normalize.
Great comment. Joe, why don't you summarize the call for the audience?
Yeah, again, we want to have why there's optimism for the second half of the year and why it could be better than the first half. Interest rates, we see that not going as high. We start seeing inflation cool off. You're still seeing a healthy consumer spending, and that's anyone traveling. We didn't touch on the US dollar. That's been extremely strong. We know a number of our clients have traveled overseas, and they've been able to save quite a bit of money. So it's a good time, even though it's really hot and the tour is almost coming to a close. But these are positives. Spending good, interest rates not going up as high. You get better clarity, which helps sentiment. And that's a short-term driver for the market, where we can start seeing a shift from overly negative to positive. And then we get earnings coming out, and they're going to be better than expected. So better than feared. So those are the reasons why we see optimism for the second half of the year.
This is Tom Hulick, the CEO of Strategy Asset Managers, and we are signing off today. Have a great rest of the week.